Welcome back. The Indian economy has registered its fastest growth in a year on the first quarter of this fiscal. Data released by the National Statistical Office shows GDP growing at 7.8% in April to June this year. Though the figure is much lower than last year, it's also much higher than the growth in the preceding quarter. Figures also show a good uptick in the agri sector as compared to last year. However, indicators for other crucial sectors like manufacturing, industry and services are considerably below the previous year's figures. Even the capital formation growth this year is lower than last year. So what do these GDP numbers mean? How has the high base effect skewed the data? Is the comparison to last year even fair? These are some of the questions Managing Editor of BTTV, Siddharth Zarabi, posed to the Chief Economist of ICRA and Bank of Baroda. Listen in.
7.8% GDP growth in the first quarter versus 13.1% a year ago in the same period. This is bang in line with the estimate that we told you viewers. GVA growth for the same quarter, 7.8 versus 11.9% a year ago. Farm sector growth 3.5% versus 2.4% a year ago. I'm going to quickly rattle through some of the numbers. This big number right up there on the screen. Mining sector growth at 5.8% versus 9.5% a year ago. Manufacturing growth at 4.7% versus 6.1%. The big number, of course, being 7.8%, the fastest in 4 quarters. Construction sector growth at 7.9% versus 16% in the same period a year ago. So we have construction, we have manufacturing, we have mining, we have farm sector, and we have the big number on the screen. Quick reaction, Aditi, as I get more fine print.
So Siddharth, I've just glanced at the release, and I think on a sectoral basis there are 3 or 4 sectors which are standing out where the numbers that are coming from the NSO are below our forecasts. One is the trade, hotel and transport component, which is that big component of services where we expected that a latent recovery to really push a very high double-digit growth. So that's come in at a healthy number, but definitely below what we were expecting. Secondly, even the manufacturing GVA growth is not as healthy as what we thought based on the margin benefit that both Madan and I were talking about. And I think the third is agriculture, where the number has come in a little bit below what we were penciling in. But overall, I would say 7.8%, very close to what the MPC had projected. And quite a good number, I would say. It's below what I was penciling in, so certainly I'm not going to be looking at revising my full year growth number very much because of this. But I would say overall, still we remain concerned that there would be a dip in the pace of YOY growth going forward, because as we were discussing, this number that's been pushed up by the base effect. Okay,
2 more data points as I get them. One is private final consumption growth at 6% versus 19.8%. So 6 versus 19.8, that's private final consumption. Capital formation only at 8% versus 20.4%. Government final consumption growth at a negative 0.7% versus 1.8% a year ago. Madan, your reaction to these numbers that you are hearing from me?
Overall, if you're looking in terms of the GDP growth numbers, I think more or less on expected lines. So I think 8.1 to 7.8 doesn't really make much difference. I think in agriculture we were looking at something higher, but we get a number of 3.5% here. But I think the interesting thing which you pointed out is in terms of consumption, because I think that's something which has been irking us. We've always been talking in terms of consumption picking up, and there's this question of whether we'll have to wait for the second quarter or the third quarter for consumption. So I think it does look like that cumulatively high inflation which we have seen over the last 3 years is something which has probably come in the way of consumption.
Do you think we can expect more fiscal administrative measures to ensure that prices remain calm and don't cause a bigger political problem?
So to start with, I mean, if we look at where we are with the monsoon right now, I think even with a 20% surplus in monsoon rainfall in September, we'll barely be at the lower end of what is considered normal for the entire monsoon season. So, we should probably be prepared now that this is going to be below normal monsoon. And I mean, it's been erratic in any case. It's really not been a great distribution so far. And I think we're going to end up with a below normal monsoon this season. Now, given the kind of supply-demand dynamics that are driving food inflation, I should certainly hope that there are fiscal measures to address some of these issues rather than leaving it to monetary policy, which is going to be extremely blunt as a tool to dealing with the kind of things that are pushing up inflation right now. So I do hope that there will be some measures that the government will be bringing in, and they've been very proactive so far in any case. So I don't think that this hope is necessarily misplaced.
That's how we leave it on the show tonight. Thanks for watching.